Hello and welcome to this session in which we will discuss risk mitigation. Risk is a fundamental aspect of existence. We exist, there's always risk. It appears in many different scenarios and shapes. For example, if you have a company and your data is online, there's always the risk of what? A data breach, a cyber attack on your information. If you invest in the stock market, there's a financial risk that you could lose your money. There's also the physical risk with high speeding. Sometimes just by walking, you could slip. That's a physical risk. Environmental risk. If there's earthquake or hurricanes, that's a risk too. So in essence, simply put, risk is present in any situation when there's a chance, a probability of experiencing a loss, and that's everywhere, especially in circumstances that expose us to the possibility of that loss. Well, there's a risk everywhere, but if you expose yourself to that risk, guess what's going to happen? The probability of going through that risk will go up. So what can we do? Since risk is everywhere, we need to mitigate that risk. We need to somehow deal with it. So the goal of risk mitigation isn't to completely eradicate risk. You cannot 100% bring risk to zero. So you want to do what? Bring it from medium or high to low as possible. But risk cannot be zero. Risk is always zero. I'm sorry to tell you this. When you die, there's no risk anymore. You're done, okay? But it's impossible or impractical to reduce the risk down to zero. So we have to face the risk. Instead, we focus on strategically selecting from different methods to manage risk. And strategically selecting different methods aims to do what? Minimize the risk, minimize the catastrophic financial losses if we're talking about a business. So by identifying and addressing risk in a thoughtful manner, first you have to identify, you know what your risk is. Whether you're an individual or an organization, you can protect yourself without necessarily avoiding all risk. You would love to avoid all risk. And again, avoiding all risk, if you do it, it means you have no return or you don't exist in that particular place, market, situation. So this balance in key risk mitigation allows for the pursuit of opportunities or activities with a clear understanding and management of the associated risk. So you cannot live by yourself, live in your home and close the door on yourself and say, I'm safe. There's always a risk in that as well. You could go insane, right? But the point is, you want to find the balance where you're going to face the risk but mitigate the risk. This is what we will discuss in this session. How to mitigate. What are the risk control methods? Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. So risk control methods are strategies used to manage and mitigate potential risk. These methods can be categorized into 4 types: risk avoidance, risk reduction, risk retention, risk transfer. Now, each of these approaches offer a unique response to risk depending on the nature of the risk and its severity. So the choice depends on 2 factors. How often the risk is likely to occur? What's the frequency? What is the probability of a risk happening? There's a probability. It could be high, it could be low. And if that risk materializes, what is the potential damage? What's the severity? So we look at the frequency. Frequency is a percentage. Think of it as a percentage. Is it 10% it's going to happen, or is it 99% it's going to happen? That's the frequency. Severity. Will the damage be $1,000 or will the damage be $1 million? $1 million. Just to kind of give you an idea. Starting to deal with risk avoidance. Now, for each one of those, what I'm going to do, I'm going to explain what it is, tell you under which circumstances it will be used, and give you some examples to absorb. So risk avoidance is what? This is when you completely steer away of the risk. Now, I said steer away from the risk. It means a steer away from the risk that you don't want to face. Now, there are certain risks exist whether you choose or not, but there are certain risks that you want to avoid altogether. Now, when to choose risk avoidance? You choose risk avoidance when the probability of the event happening, the severity, the probability of the event happening is high. There's a high risk. And the damage is high. The severity is high. So this method is chosen when no effective response to the risk available or when the risk is too high to manage effectively. Usually you would avoid this activity altogether. So for example, instead of investing in stock, you choose to invest in government bonds. So what you did here is you avoided the stock. This is called risk avoidance. You don't want to invest in equities. You don't want to invest in the stock market. You choose to invest your money with the government. Why? It's safer. So what you did, you just avoided the stock altogether. Now, can you invest in the stock and manage the risk differently? Yes, you can invest in the stock and reduce your risk. For example, you can buy derivatives to reduce your risk. But this is just an example to tell you I want to avoid this. Or deciding not to engage in extreme sports to avoid the risk of serious injuries. Just forget it. I don't want to be involved in this. I'm not going to play extreme sports. This is risk avoidance. So this is a decision you made to stay away from this activity because the frequency is high of an accident happening and the severity is high as well. What is risk avoidance? It's a strategy aimed to lessen, reduce the severity of the likelihood of the risk occurring. When to choose this method? You would choose this method when it's a high frequency risk. There's a good chance it's going to happen, but the severity is low. Severity means what? If it happens, the damage is not too bad, but it could happen a lot. So what do? You want to reduce the frequency. It does not eliminate the risk, but it makes it more manageable. For example, to reduce the risk of data breaches, because it could happen, the company might implement an advanced cybersecurity measure. So what you're doing is you're reducing the risk. You might still be subject to a cyber attack, but you reduce the risk. Installing a smoke detector in a home to reduce the risk of undetected fire. A fire could happen, but you want to reduce that risk. Theft, you put a security camera. So you're trying to reduce the risk because when the thief sees the security camera, they might not go ahead and with their crime. Risk retention. What is risk retention? Risk retention, you're saying, bring it on, I'm willing to take that risk. This approach involves accepting the risk and dealing with any consequences internally. This is basically, in a sense, called self-insurance. Often, when the cost of transferring the risk is too high. So if the cost of transferring the risk, which we did not talk about yet, transferring the risk means what? It means buying insurance. That's what transferring the risk is. We'll talk about transferring the risk in a moment. But if you choose not to transfer the risk, you want to accept this. When do you do this? When the frequency of the risk happening is low, the percentage of that event happening is low, and there is a low severity. And if it happens, it's not really a big deal. For example, a small business decide to retain the risk of minor customer injuries, like slips and fall, for themselves rather than buying extensive liability insurance. So they don't want to buy the liability insurance. They want to keep it for themselves. They're willing to take that risk and pay out of the pocket. So choosing to pay also for minor car repairs out of pocket instead of making insurance claim to avoid increased premiums. So if something happened to your car, you don't file a claim, you just accept that risk and say, you know what, I don't want to buy insurance for that. I will fix the car myself. For example, home appliances, for minor wear and tear on home appliances, what you do is you don't buy insurance, you will just accept that risk. So this is in a sense called self-insured. So you just say, you know what, I am going to take care of this by myself. You are not transferring the risk, because the next thing we're going to discuss is when you transfer the risk to someone else. When we discuss transferring risk, think about insurance. Now, rather than self-insurance, you are buying insurance from a third party. Here's how it works. This method involves shifting the risk, transferring the risk to another party, often through insurance or some sort of an agreement or other legal means. When to choose this method? When the frequency, low frequency risk, but the severity is high. So there's not a good chance it's happening. The probability of that happening is not high, but if it happens, it's severe. I don't want to take any chance because it's severe. So what you do now, a contractor might transfer the risk of construction accident to an insurance company through a comprehensive insurance policy. You don't want to take that risk because the severity is high. renting a car with an insurance package to transfer the risk of damage or theft to the rental company. Insurance for medical purposes, medical emergency, can be financially devastating. Let's take a look at this example covering all risk control method in one scenario. Assuming a car. What can you do? If you don't like to own a car because there is a risk of owning a car, you don't own a car. You just use public transportation. So what did you do? You avoid risk avoidance. You avoid owning a car. Or if your fear of owning a car is theft, what you do is you buy the car and you install alarm system. Now you reduce the risk of theft. What can you do for risk retention? You own the car if you decided to. For minor dents and scratches, you would say, I'm going to pay this out of my own pocket. Well, what you did is risk retention. And risk transfer is you buy the car and you purchase insurance. Let's take a look at this multiple choice questions from farhatlectures.com. In the context of risk management, what does transferring a risk typically involve? Transferring a risk. Is it taking action to completely to avoid the risk, implementing measures to reduce the risk's impact, accepting the risk and its consequences internally, sharing the risk with another party such as insurance company? Well, taking action to completely avoid the risk, this is risk avoidance. This is not transferring the risk, this is risk avoidance. Implementing a measure to reduce the risk's impact, this is reducing the risk, not transferring the risk. Accepting is retention. You're accepting the risk. So the answer is sharing the risk with another party, especially through insurance, is a form of transferring the risk. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you prepare for your CPA exam, accounting courses, or any other professional certification you are undertaking. Invest in yourself. Good luck, study hard, and of course, stay safe.